Hello everyone, welcome to the new topic of higher financial accounting, accounting for debentures. Give the heading in your notebooks, accounting for debentures. Now, whatever portion I suggest that you'll be writing in your notebooks, some portion you need not write from this lecture, but wherever I mentioned, you will be supposed to write in your notebooks. So first you give the heading in your notebooks, accounting for debentures. Now let us first understand the meaning of debentures. See, debentures is actually derived from the word debere. It's a Latin word, and debere means to owe. So, how can a public company, joint stock company, collect huge funds to continue its business operations or to start its business operations? One alternative is they issue shares to the public and collect huge funds from the public. But if they offer shares to the public, they have to confer ownership to them. So shareholders become the owners of the company. Now company may not want to part with the ownership. Company needs money, but company does not want to give ownership to the person providing the money. In shares, company has to provide the ownership to the shareholders. So like you may borrow a bank loan. Okay, you may borrow a loan from the bank, but bank does not become the owner of your business. Okay, in that way, if you want to collect huge funds from the public, but do not want to give them the ownership, then the alternative is collecting the money through debentures. So it is as good as shares, but you collect huge funds from the public, but you don't give them ownership. They are the creditors of the company. Okay, so what is debentures in detail? All of you write down in your notebook. This you need to write in your notebook. So give the heading meaning of debentures. Okay, give the heading meaning of debentures and write down this. As per section 2 subsection 30 of the Companies Act 2030. You can remember the Companies Act definition. Debenture includes debenture stock or bonds or any other instrument. Okay, particularly remember instrument means a certificate or a document. Instrument means a certificate or a document of a company evidencing a debt, whether constituting a charges on the assets of the company or not. Basically, what is this certificate or a document? Company gives this certificate to the public, and the company evidencing a debt means acknowledges, accepts in writing that they owe money to them. They have borrowed money from them. So how does the company acknowledge, or how does the company accept that they have borrowed money from the public and they owe to return it back in future? With the help of company's attestation, seal, stamp. Like in 10th standard, 12th standard, when you passed out, then you used to get the true copies done. What were those true copies? You used to take the Xerox copy of your mark sheet, Xerox copy of your attempt certificate, leaving certificate and other documents, and you used to take the stamp of the school on that, on which principal used to sign. That used to become a true copy. Why we used to call it as a true copy? Because there may be manipulation, there may be fraud in the Xerox or in the carbon copy. So wherever you submit these documents in future, they need a true copy. Means principal of your school would verify the original and compare it with the Xerox and see whether each and everything mentioned is alike and same to same or not, and then only principal would sign. So once there is a principal's signature and company's stamp on that, that means it becomes a true copy, as good as original copy. Same way, company also does the true copy, self attestation of this. Okay, in the document, company mentions in writing that company owes or accepts to repay the money to the debenture holders after how many years. So what all terms and conditions are mentioned in this document? Maturity period. After how many years will the company pay back the money? Rate of interest. What rate of interest company will pay on that? Assets mortgaged. If any assets are secured or hypothecated against that, that is also mentioned in the particular document. So once again, look at it. As per section 2 subsection 30 of the Companies Act 2013, Debenture includes debenture stock, bonds, or any other instrument of a company evidencing a debt. And how do the company evidence this debt? By the self-attestation stamp or a seal. Means they mention in writing that you hold so many debentures. This is the face value of the debenture. This is the interest you are going to get. There is a maturity period. Everything is given in writing. Whether constituting a charge on the assets of the company or not, means whether assets are mortgaged or not. If assets are mortgaged, then that will also be mentioned in the document. Okay, I hope everyone would have written it. Otherwise, you can pause the video and write it down. We proceed further. Now, before we proceed further with the accounting part of debentures, let us first understand difference between shares and debentures, because shares chapter we have already studied in detail. So what are the minor differences between shares and debentures, or you can say rather what are the major differences between shares and debentures? This you are not supposed to write in your notebook. You already have it in your study material. I repeat, this you are not supposed to write in your notebook. You already have in your study material. So who are the shareholders? They are the owners of the company. Shareholders are the real owners of the company. And who are the debenture holders? They are the creditors of the company. As I said in the beginning itself, company wants to collect huge funds but does not want to give ownership. Then it will issue debentures. Okay. So generally the face value of a share is 10 rupees, whereas debentures face value is 100 rupees. Means on a single share you can collect 10 rupees minimum, whereas on a single debenture you can collect even 100 rupees minimum. So first difference, shareholders are the owners, debenture holders are the creditors. Second difference, shareholders have voting rights. When we have to vote for the board of directors in the annual general meeting for the different decisions of the company, shareholders can vote in that because they are the owners, obviously. But debenture holders have no voting rights. They cannot vote and take the decisions, important decisions in the annual general meeting of the company. Third difference, shareholders get dividend in return. Okay, when they invest the money in the company, company has to pay dividend on shares. Whereas on the debentures, it's a debt. It's like a loan borrowed from a bank. But here you borrow that loan from the public, so you have to pay interest. Okay, on shares you have to pay dividend. On debenture holders you have to pay interest. And last, shareholders don't get their money back until the liquidation. No cash back. Means shareholders will get the capital back only when the company goes into liquidation. They are the owners of the company. They have to remain with the company till the company dies. Whereas debenture holders have fixed maturity period, 100% money back guarantee. After some years, they are going to be returned back the money. There is one breed of debentures, category of debentures called irredeemable debentures, which are repaid the money only when the company goes into liquidation. But in India, as per Companies Act, irredeemable debentures cannot be issued. So from India's scenario point of view, shareholders never get their money back. They get it back only when the company goes into liquidation. Whereas debenture holders get their money back after some fixed matured period of time. Okay, so these are the principal four differences between shares and debentures. You already have that in your study material. Now we proceed to the most important part of this lecture today. Give the heading in your notebooks. Topics covered. Okay, which all topics are going to be covered? You have to write that. You have to write this in your notebook. Give the heading topics covered. There are two main topics covered in this chapter. So if you write down this in the form of a chart. First topic covered is issue of debentures. So if you write down this in your notebook, first topic covered is issue of debentures. Whereas second topic covered is redemption of debentures. What do you mean by redemption? We also covered and studied the topic of redemption of preference shares in part. So what do you mean by redemption? Repayment. Okay, redemption means repayment. As we discussed, debentures 100% money back guarantee. So we also have the topic of redemption of debentures. We did not have this topic in equity shares because they cannot be returned back the money. So here we also have the topic of redemption of debentures. Now with an issue of debentures, we shall be studying with two topics in detail. One is issue of debentures for cash. All of you have to write this in your notebook. And second is issue of debentures for consideration other than cash. Now, what do you mean by issue of debentures for cash? For cash means for cash. You get cash. Basically, you get the money in your bank account. You issue the debentures, you get money. And for consideration other than cash, we studied in shares also. You issue the debentures, but you don't get money, cash. Now, if you don't get cash, then what do you get? You get assets. Or if you take over entire business, then you get assets and liabilities. Okay, so I repeat, issue of debentures for cash means you get cash, you give debentures. Issue of debentures for consideration other than cash means you get assets, or if you take over the business, you get assets and liabilities, and against that you give your own debentures. So pause the video and write down this chart. These topics are going to be covered in your chapter of debentures. Today we will be covering the first topic, issue of debentures, within that A point for cash. I repeat, in today's lecture we'll cover in detail issue of debentures for cash. Redemption we'll see in detail when we come to that particular lecture. Let's proceed further. Now, as I said, we'll be looking for the entries of issue of debentures first. So give the heading again in your notebook. First topic, issue of debentures. Okay. Give the heading first topic, issue of debentures. Within that, point A for cash. Now, when you issue the debentures, whether for cash or for consideration other than cash, you can issue the debentures in three different ways, either at par or at premium, and in case of debentures, you can even issue at discount. In shares, the companies are prohibited, not allowed, to issue the shares at discount as per Companies Act 2013, recently. Okay, but debentures can be issued at par, premium, or discount. Discount means lower value. Premium, we know, you issue it higher than the face value. Discount means lower value. And keep it in mind, shares face value is generally 10 rupees, but debentures face value is generally rupees 100. I repeat, debentures face value is generally rupees 100. So first entry, all of you write down, for issue of debentures at par. Now, we will be having in our questions entire money of debenture called with application only at one go. So unlike shares, means in debentures also you can call the money as application, allotment, calls. In that case, the entries will remain exactly same as shares. Like what was the entry for application money received in shares? Bank account debit to share application. Replace the word shares with debentures. It would become bank account debit to debenture application account. Second entry was share application account debit to share capital account. So it would become share word will get replaced with debenture. Debenture application account debit to debenture capital account. Now here we don't write debenture capital. Instead of debenture capital, we simply write the word debentures. They are the borrowed capital, so the word capital need not be used for that. So wherever it comes share capital, here it becomes debenture capital, but instead of debenture capital, we simply write the word debentures. So it would become debenture application account debit to debentures account. And in the same manner, the entries will be passed for allotment and calls. However, as I said, in case of debentures, we will be collecting entire 100 rupees in lump sum at one go only. So we won't have application, we won't have allotment, we won't have calls. In that situation, what entry we will pass? Write down in your notebooks, issue of debentures at par. Bank is the receiver, debit the receiver, bank account debit. I repeat, bank is the receiver, debit the receiver, bank account debit. And debentures are our liability. We have to pay back the money to debentures after 5, 6, 7 years period of time, whatever is the maturity period, depending on that. So debentures are payable, credit the payables to debentures account. I repeat, bank is the receiver, debit the receiver, bank account debit, debentures are payable, credit the payable, they are our liability. So debentures are payable, credit the payable to debentures account. Now throughout the chapter, I repeat, throughout the chapter, remember that debenture will always be recorded with face value. Wherever the debentures account come, whether in credit or in debit, everywhere debentures will always be recorded with face value. Keep this in mind. Okay, throughout the chapter, wherever debenture account is to be recorded, it will always be recorded at face value. Now, we discussed that what is the face value of a debenture? Generally 100 rupees. You need not write the amount, just for your understanding I am writing the amount also. So here you would write 100 rupees, and obviously against that we will receive also 100 rupees because we are issuing at par. So bank account also you will debit with 100 rupees. Just for your understanding, amount you need not write. I hope everyone is clear with the first entry. Now next entry. All of you give the heading issue of debentures at premium. As I said, company collects the entire money in one go, lump sum, one installment only. Now, bank is the receiver, debit the receiver, bank account debit. I repeat, bank is the receiver, debit the receiver, bank account debit. Again, premium means we are going to collect more money. So first of all, again, debenture is our liability, payable, credit the payables to debentures account. With what amount? Face value. Write in bracket face value. Okay, wherever you write debentures, write in bracket face value. And what is this? Premium for the company, capital profit. I repeat, one-time profit. Company is not going to receive this again and again. Now, where do we used to transfer the premium received at the time of issue of shares? Security premium account. So as per the Companies Act, we need not open separate premium accounts for shares, debentures, bonds, etc. Share premium, debenture premium, bond premium. No, we open only one premium account, which is security premium account. Whether you issue shares or you issue debentures or you issue bonds or any other security, these all are securities. So here also we will write security premium account only. Okay, premium is our income, capital profit. Credit all incomes and gains to security premium account. I repeat, bank is the receiver, debit the receiver, bank account debit. Debenture is our liability, so debenture is payable, credit the payable to debentures account, and premium is our capital profit. So premium is an income, credit all incomes and gains to security premium account. Now regarding the amounts, how do you record it? First you record the amount of debentures, that is with face value, say 100 rupees. Okay. Then you record the amount of premium. Suppose we collect 10 rupees of premium, 10% premium on face value. Now tell me, how much amount would you receive? If you collect 10 rupees more, how much amount would you receive? So bank account you would debit with 110. Okay. So when we solve the practical questions at that time also you follow the same practice. First you record the amount of debenture. Then you record the amount of security premium, and then total amount you record for bank. I hope everyone is clear with that. Next, and obviously wherever required you can pause the video, rewind and understand it again if there is any confusion. Third, issue of debentures at discount. Now what is this discount for the company? Capital loss. Okay, opposite, antonym of premium, capital loss. Because you are going to collect lesser money. Instead of 100 rupees, discount means you'll collect 90, 95, lesser than 100. So it's a loss for the company. So what would be the entry? Bank is the receiver, debit the receiver, bank account debit. As we discussed, what is discount for the company? Capital loss, one-time loss. Okay, capital loss because it's a one-time loss. Only when the company issues the debentures, they are going to face this, not every year. So debentures discount is a loss for the company. Debit all expenses and losses. So discount on debentures account, debit. And debentures are liability, payable, credit the payables. So to debentures account. Now debentures always you'll record with face value. Correct? Now again here, how will you record the amounts in the practical questions? First you'll record which amount? Come on, tell me. Which amount first? Come on. Yes, debentures with face value 100. Then you will go with which amount? Yes, which amount? Discount. Suppose 5 rupees. Now tell me, if you give discount of 5, what amount are you going to receive? 95. 100 minus 5, 95. So in practical questions, follow the same pattern. First you record which amount? Debentures. With what amount? Face value. then you record premium or discounts amount, and then you record bank amount. Use your common sense. Premium means what amount would you receive, including that. Discount means what amount would you receive, subtracting that. Okay, so mainly these entries you are supposed to remember for issue of debentures. Now, redemption we are going to do in future, but redemption will have effect on issue also. Okay, see, you have to inform to the debenture holders in advance how you are going to redeem the debentures, how you are going to repay the money after 6, 7, 8 years period of time. In two ways you can redeem the debentures, either at par or at premium. You cannot, I repeat, you cannot repay or redeem the debentures at discount. Just imagine, I tell you, you give me 100 rupees today, repay means redemption. You give me 100 rupees today and I will return back to you 90 rupees after 5 years. Would you give me the money? Obviously not. So as per the Companies Act, you cannot repay lesser money. You cannot redeem at discount. Either you can redeem at par or at premium. And company has to inform this to the debenture holders when the company issues the debentures at that point of time itself. Means you know in advance how you are going to repay the money after 5 or 7 years. That has effect on issue also. So right now what we are studying is not the redemptions entry. I repeat, right now what we are studying is not the entry of redemption, but what? Give the heading, effect of redemption on issue. Okay, what we are studying is not redemptions entry, but effect of redemption on issues entry. Redemptions entry we'll study in the further lectures in detail. So this also entry is to be passed at the time of issue of debentures only. How the debentures are going to be redeemed will affect the entry of issue also. Okay, I hope everyone has given this heading. Now, as we discussed, you cannot redeem at discount, you can redeem only at par or at premium. So if the debentures are redeemed at par, if the debentures are redeemed at par means face value 100 rupees only, then it will have no effect. Write down no effect. Means on issue it will have no effect. Now look at the left and right side both, everyone. First, issue of debentures at par and here redeemed at par. Okay, first situation in your practical questions. If debentures are issued at par and redeemed also at par, then redeemed at par will have no effect. So entry of issue at par will remain as it is, bank account debit to debentures account. Second situation, issue of debentures at premium on the left side, see that. On the right side, redeemed at par. So redeemed at par will have no effect. So on the left side, issue of debentures at premium entry will remain same. Bank account debit to debentures account to securities premium account. Now again look at the third situation. Left side, issue of debentures at discount. Right side, redeemable at par. Now right side, redeemable at par will have no effect. So on the left side, issue of debentures at discounts entry will remain same. Bank account debit, discount on debentures account debit to debentures account. Now we understand the concept of if redeemed at premium. First of all, let us understand one thing. Okay, I hope everyone has written up till here. If redeemed at par, no effect. Now if redeemed at premium. Now just don't write, be attentive. What is this premium which the company collects at the time of issue of debentures? When the company issues the debentures and collects the premium, they are going to receive more amount. I repeat, they are going to receive more amount. You are issuing the debentures. But if you are redeeming at premium, okay, it's opposite. Now you are paying more money. So if you are going to redeem at 10% premium, then 100 rupees you borrow right now, but you will repay 110 after 5 years. Here you are going to pay more. There is a difference. So both the premiums are different. The premium which is raised at the time of issue, you are going to receive more. The premium which is going to be paid more at the time of premium. Okay, that is you are going to pay more. That premium you are going to pay more amount to the debenture holders. You are receiving more means it's a capital profit. You are paying more, it's a capital loss. Keep this difference in mind. Premium at the time of issue is a capital profit, but premium at the time of redemption is a capital loss. Now, here the principle of prudence will apply. You studied one principle of prudence or conservatism in accounting concepts and conventions. What was that principle of prudence or conservatism? Recollect it. What was the principle of that prudence or conservatism? As per the principle of prudence or conservatism, you don't consider if you are going to earn any profit in future. Means ignore the profits if you are going to earn in future. But if you are going to incur any loss in future, make the provision from right now. If you are going to incur any liability in future, make the provision from right now. Therefore, in past, closing stock was always valued at cost price or market price, whichever is less. Which principle we used to apply? Conservatism or prudence. Because if market price is less, it's a loss. Future expected loss. We consider that. We make a provision for that. So we record the lower amount. But if cost price is less, that means market price is more, then it's a future expected profit. We don't consider that. So we record the lower amount, that is cost price. Again, we used to make provision for bad debt reserve, discount reserve. By which principle? Conservatism principle. So what was this conservatism principle exactly? Record and make a provision for anticipated losses which are expected to occur. This is a concept of playing safe, on the safer side. Like your parents provide for the daughter of marriage since so many years back. Why they start making a provision? Because it's a future expected expense. They know they are going to incur that. But imagine if you are going to earn salary in the next month, will you start spending from right now? Hooray, we are earning the salary in the next month. No. So don't anticipate any profits. Means income will be taken into consideration only when it is actually earned. So this is the principle of conservatism. And that principle of prudence or conservatism applies at this premium on redemption also. What is this premium on redemption? Can I say future expected loss as well as future expected liability? Once again, write down this in your notebook. What is this premium on redemption? Okay, what is this premium on redemption? First of all, it's a future expected loss, because when you issue the debentures, at that time itself, you know that in future you are going to pay back 10 rupees more or 15 rupees more. It is a future expected loss. As well as it is a liability, because you have to pay that 10 or 15 rupees more in future. So here we apply the concept of prudence. Here we apply the concept of conservatism. Because we already know after 5 years you have to pay 10 rupees more. So every year you start providing 2 rupees aside from the profits. So then you accumulate 10 rupees and you are in a position to pay that 10 rupees more after 4 or 5 years. Prudence, playing safe, making a provision from right now. Okay. So if the debentures are redeemed at premium, then what entry would be passed? Understand it. It is a loss for the company as well as liability. So what entry would be passed in that situation? Loss on issue of debentures account debit, because it's a loss. Debit all expenses and losses. And as well as it's a liability. So premium is also our liability. It is payable back after 5 or 7 years. Credit the payable. So do premium on redemption account. Okay. So if debentures are going to be redeemed at premium, then what entry will you combine at the time of issue? This is the effect of redemption on issue, means you have to combine this entry at the time of issue. So what entry will you combine at the time of issue? Loss on issue of debentures account debit to premium on redemption. Logic. Premium on redemption is a loss for the company. Debit all expenses and losses. So loss on issue of debenture account debit as well as premium on redemption is a liability for the company. Credit the payable, so to premium on redemption account. Now, see on the left side and on the right side. How will we pass the entries of issue? Understand this. 3 situations we already studied. issued at par left side, redeemed at par right side. Second, issue at premium left side, redeemed at par right side. Third, issued at discount left side, redeemed at par right side. Now fourth situation, issued at par left side and redeemed at premium right side. I repeat, fourth situation, issue of debentures at par on the left side, redeemed at premium on the right side. Now if you combine the two entries, look at the left side, bank account debit to debentures account issued at par. Look at the right side, loss on issue of debentures account debit to premium on redemption, redeemed at premium. If you combine these two entries, then left side, bank account debit, you'll get over here in the combined entry. Right side, which account is debited? Loss on issue of debentures account debit, you'll get it in the combined entry. Left side, to debentures account with face value, you'll get it in the combined entry, credited. And look at the right side, to premium on redemption account, credited in the combined entry. So if you combine this first entry of left and second entry of right, issue of debentures at par and redeemed at premium, then what entry will you get for this fourth situation? Issue at par, redeemable at premium, bank account debit, loss on issue of debentures account debit to debentures account to premium on redemption. You need not write this in your notebook, because when we practically solve the questions, we will pass two single entries only. In a way, we get a combined entry. Means we will be passing the entry of issue, leaving one line in between of debit and credit amount. So bank account debit, then you leave one line, then you credit to debentures account. And then the line which you have left in between, in that you debit loss on issue of debentures, and at the end you credit to premium on redemption. Why we will pass two single entries? Number one benefit, you get the combined entry very easily, automatically. Number two benefit, you'll not make mistakes with amount. Because if you directly pass a combined entry, you'll get confused with amount. So if you pass two single entries, we know what amounts are to be recorded at the time of issue and what amounts are to be recorded at the time of redemption. So mistake with amount will also not arise. Now same way, fifth situation, left side, issue of debentures at premium, right side, redeemed at premium. So premium, issue also at premium, redeemed also at premium. See on the left side, issue at premium, which account is debited? Bank account debit. So that will get in the combined entry, bank account debit. Look at the right side, redeemed at premium, which account is debited? Loss on issue of debentures account debit. So that will get in the combined entry, loss on issue of debentures account debit. Look at the left side, if issued at premium, which accounts are credited? To debentures account with face value. So here also we'll get to debentures account with face value. And also on the left side, there is to securities premium account. So that also we will credit to securities premium account. And right side, now we have to premium on redemption account. So here also we will credit to premium on redemption account. Means two premiums will come here, security premium also and premium on redemption also, but with different logics. Security premium, it's a profit, it's an income, credit all incomes and gains. And premium on redemption, it's a liability, credit the payable. So two premium on redemption. So this would be the combined entry for fifth situation. If debentures are issued at premium and redeemable also at premium, then bank account debit, loss on issue of debentures account debit, to debentures account, to security premium account, to premium on redemption account. And lastly, sixth situation. Look at the left side, issue of debentures at discount, and look at the right side, redeemed at premium. Okay, so issued at discount, redeemed at premium. Now left side, which accounts are debited? Very first, bank account debit. So here we'll get bank account debit. Then again look at the left side, there is one more account debit, discount on debentures account debit. So on the right side, discount on debentures account debit. Look at the right side, we have loss on issue of debentures account debit. So that will also get debited, loss on issue of debentures account debit. Now again look at the left side, we have two debentures account with face value. So two debentures account with face value. And look at the right side, we have to premium on redemption. So to premium on redemption account. Means what will be the combined entry if sixth situation, debentures are issued at discount and redeemable also at this premium? Then bank account debit, discount on debentures account debit, loss on issue of debentures account debit, to debentures account, to premium on redemption account. So 6 situations are possible: issue at par, redeemable at par; issue at premium, redeemable at par; issue at discount, redeemable at par; and then issue at par, redeemable at premium; issue at premium, redeemable at premium; issue at discount, redeemable at premium. Now, what is this loss on issue to premium on redemption to be done further? So one more entry we will pass, all of you write down in your notebook: writing off of premium on redemption or loss on issue. So let us understand the entry for writing off the loss on issue of debentures account. All of you write the heading in your notebooks for writing off loss on issue of debentures. Okay. Normal entry we have been studying since 11th standard for writing off the losses. What entry we used to pass for writing off leasehold assets written off, goodwill written off, patents written off. Same entries to be passed here. For writing off the loss on issue of debentures, whatever proportion of amount is provided, like I said, out of 10 rupees, 2 rupees will keep aside from P&L account every year, right? If the company has the balance of security premium, then company will write off entire loss from security premium. So security premium account debit. If security premium is insufficient, then company will write it off from profit and loss account. So profit and loss account debit. Okay, I repeat. If company has sufficient balance of security premium, then security premium account debit. If company has insufficient balance of security premium, then remaining amount will take from profit and loss account debit and to loss on issue of debentures account. Okay, I repeat it once again: security premium account debit, profit and loss account debit to loss on issue of debentures account. Write it down in a notebook: security premium account debit, profit and loss account debit to loss on issue of debentures account. Now let us practice with 2 practical questions related to this topic of issue and redemption mixed. Redemption's effect on issue. Take out your notebooks and take out question number 1 of your study material. Look at question number 1 of your study material, be attentive. ABC Limited issued debentures on 1st April 2017 and on same day, now this you mark it important and underline it, security premium account had a balance of rupees 50,000. So as we discussed that last entry just now, if we have to write off that premium, then up to 50,000 will write off from security premium account. Remaining we will write off from P&L account. Past journal entries at the time of issue of debentures. You can see 6 situations are given to you. All the 6 situations which we discussed are covered over here. So make around 2 pages format, big format. Journal entries in the books of ABC Limited for 2 pages. One more thing, in the beginning where you have written all the entries in the summary, over there leave 5 pages. I repeat, leave 5 pages in the summary so that whatever new concepts we study in this chapter, you can write all of them at one place in your summary itself. So leave 5 pages in the beginning. Okay, make the format of 2 pages for journal entries. Pause the video and make this format. I hope you all have done the format. Now look at the first situation. Okay, be attentive. Company issued, underline issued, 2012% debentures of rupees 100 each, underline at par. Okay, how they have issued the debentures at par. And then underline redeemable also at par. Okay, issued at par, redeemable at par. So what entry will we pass for this? Understand it? All of you write down the first entry, first situation what we are doing right now in your notebook. Issue at par, redeemable at par. Now first entry what will come for that will be, now issued at par, so we'll pass the entry bank account debit. Now all of you leave one line, as I said we'll leave one line in between. Okay, here no need to leave one line, we'll leave one line only if they are redeemable at premium. Here redeemable at par will have no effect on the entry of issue. Okay, redeemable at par will have no effect on the entry of issue. So entry of issue at par will remain as it is. So 2. Now which debentures are issued? 12% debentures. So we'll have to mention that prefix of rate of interest also. Okay, here you'll write to 12% debentures account. Now, as we discussed, debentures always with face value. So here, how many debentures are issued and what is the face value? 2000 debentures are issued and face value is 100 rupees. Okay, 2000 debentures are issued and face value is 100 rupees. So what amount are we going to record for debentures? First of all, 2000 into 100. Okay, 2000 into 100, that is equal to 2 lakhs. And obviously there is no discount, no premium, means what amount are you going to receive? Bank account also you debit with 2 lakhs. Being 2000 debentures issued at par. Now no second entry will come over here. So once again, this is a very simple situation. Since they are going to be redeemed at par, it will have no effect on issue. So entry of issue at par will remain as it is. What is the entry of issue at par? Bank account debit to 12% debentures account. What amount will be recorded? 2000 into face value 100, 2 lakhs. Only one entry will be passed for this situation. Now look at the second situation. Company issued, okay, here rupees is directly given. So straight away 40,000 is the amount. Okay. Company issued means 40,000, you can say divide by 100. 4,000 debentures would have been issued. You can mention it on the left side or right side. 40,000 divided by 100. If 100 is the face value generally, 4,000 debentures would have been issued. 10% debentures at par. So again, how the debentures are issued? They are issued at par. And further, redeemable at 10% premium. Now, since they are redeemable at premium, it will have effect on issue. What effect on issue? We have to combine the entry of loss on issue of debentures account debit to premium on redemption. So here in the entry of issue, we'll leave one line in between. We'll pass two single entries. First entry for issue at par. In that debit and credit accounts, you leave one line in between. And then you combine the effect of redemption at premium, loss on issue to premium on redemption. So how would we pass that entries? Understand it. First give the heading. Now which situation we are doing? Issue at par, redeemable at premium. So first entry in that would be for issue at par, bank account debit, leave one line in between all of you. And then you write 2, they are 10% debentures now. So 2 10% debentures account. Now as we discussed, they are issued at par. So 40,000 means we discussed 400, not 4,000, sorry, 400 debentures into 100 rupees. So 40,000 would be the amount of debentures face value, and same amount we are going to receive. So bank account also you debit with 40,000. Okay, here make the correction, not 4,000 but 400. 40,000 divided by 100, 400 debentures are issued. So what is the entry of issue at par, bank account debit to debentures, 400 into 100, 40,000. Now we'll combine this effect. What is the effect of redemption at premium? We have to combine over here loss on issue of debenture account debit to premium on redemption. So in between where you have left the line, write down loss on issue of debentures account debit. Okay, loss on issue of debentures account debit, and at the end write down 2 premium on redemption account. Now what is the amount of premium on redemption? 10% means, can I say 10 rupees, 100's 10%, 10 rupees, and 400 debentures are there. Okay, 100's 10%, 10 rupees. So what will be the amount of loss and premium? 400 debentures into 10% means 10 rupees of premium, 4,000. So this way we automatically get the combined entry and amounts confusion also does not arise. Being 400 debentures issued at par but redeemable at premium. I hope everyone is clear with it. Now, how much is the amount of loss we have to write off? 4,000 rupees, and we have 40,000 rupees, sorry, 50,000 rupees in security premium. So entire loss can be written off from security premium itself. So what one more entry we will pass? Security premium account debit with 4,000 to, we studied this entry at the end, to loss on issue of debentures account 4,000. Okay, we have to pass this entry only if debentures are issued at premium, and if security premium is insufficient, then you'll write off from P&L account, being loss on issue written off. Now we deal with the third situation. Look at it, everyone, be attentive. Third situation, company issued. Okay, again company issued. Again you are directly given with rupees. Okay, again you are directly given with rupees 1 lakh. So 1 lakh divided by 100. 1000 debentures would be there. 1 lakh divided by 100,000 debentures would be there. Company issued 1 lakh 12% debentures at a premium of 5%. Now company has issued at a premium of 5%. Okay. Now company has issued at a premium of 5%, but the debentures are redeemable at par. So once again, all of you tell me now, since they are redeemable at par, it will have any effect? No effect. So entry of issue at premium will remain as it is. Okay. Redemption at par will have no effect. So first you give the heading, situation is issued at premium but redeemable at par. Since they are redeemable at par, it will have no effect on issue of debentures. So entry of issue of debentures will remain as it is. What is that? Issued at premium, bank account debit, then 2. Now which debentures here do we have? 12%. So 12% debentures account, and also since they are issued at premium will credit to securities premium account. Now what did I tell you, if you all remember in the lecture today? First you always record the amount of debentures with face value. Here 1000 debentures are issued into 100 rupees face value, so 1 lakh. Now what is the premium? Then you record the premium. Premium of 5% will be 5 rupees. Okay, 100's 5% premium will be 5 rupees. So security premium will be 1000 debentures into 5 rupees, that is 5000. So what amount is the company going to receive? 1 lakh plus 5000, 1 lakh 5000 means on 1000 debentures company will receive including premium 105 rupees, so 1 lakh 5000. Okay, redemption at par has no effects, only this entry will be passed, being 1000 debentures issued at premium. Now fourth situation, look at it, be attentive. Company issued again rupees 1 lakh. So 1 lakh divided by 100, again there would be 1000 debentures. Now company issued 1 lakh 12% debentures at a premium of 10%, but they are redeemable at 20% premium. Now redeemable at 20% premium will have effects, so combine entries to be passed. We will combine the effect of loss on issue to premium on redemption. So first we'll pass the entry of issue at premium, leaving one line in between of debit and credit, and then we'll combine the effect of loss on issue to premium on redemption. So first you all give the heading issued at premium and also redeemable at premium. Now two entries will come here. First entry for issue at premium, bank account debit, then leave one line because we have to combine the effect of loss on issue of debenture. So leave one line in between. 2. So now which debentures here do we have? 12% again. So to 12% debentures account, and since they are issued at premium, to securities premium account. Now how do we record these amounts as we discussed? First you record the amount of debentures with face value. So 1000 into 100, 1 lakh. Now what is the premiums amount at the time of issue? 10% means 10 rupees. Okay, premium at the time of issue is 10% means 10 rupees. So 1000 into 10, that is 10,000. So what amount are we going to receive? 1 lakh plus 10,000, 1 lakh 10,000. Okay, that is 110 rupees we will receive on every debenture including premium. So 1000 into 110. So first we pass the entry of issue with its amount. Now since they are going to be redeemable at premium, we combine the effect of that. How do you combine the effect? Loss on issue of debentures account debit, and at the end you credit to premium on redemption account. Now, what is the premium on redemption? 20% premium means 20 rupees is the premium on redemption. So 20 rupees of premium on redemption. With that amount, we have to record this entry. Loss on issue to premium on redemption. Means 1000 debentures into 20 rupees, that is 20,000. So loss on issue also 20,000, premium on redemption also 20,000. Being 1000 debentures issued at premium, redeemable at premium. Now, since we have loss on issue, we have to write it off, and security premium 50,000, is it sufficient to write off the loss of 20,000 or not? Yes. So entire 20,000 will be written off from security premium account. So securities premium account debit with the amount of 20,000 to loss on issue of debentures account 20,000, being loss on issue of debentures written off. Okay, if the amount is insufficient, you would take from P&L account, but here the amount is sufficient. Now we take up with the fifth situation. Look at the fifth situation asked in the question. Be attentive. Company issued. Okay, now again company issued. Now again when they say rupees 2 lakhs, then 2 lakhs divided by 100, 2000 debentures would have been issued. 11% debentures at a discount of 5%. Now company is issuing the debentures at discount, but redeemable at par. Now again redeemable at par will have no effect, so entry of issue of debentures at discount will remain as it is. No line is to be left in between. So all of you first give the heading issue at discount, redeemable at par. Only one entry will come over here since it is redeemable at par. Issue at discount, so bank account debit, then discount on debentures account debit, and then to 11% debentures account. Now first we'll record which amount? Debentures amount with face value. So 2000 into 100. Debentures amount with face value will come 2 lakhs. Then we record the amount of discount. So what is the discount given in the question here? 5% means 100's 5% would be 5 rupees. So on 2000 debentures, what would be the amount of discount? 2000 into 5 rupees, that is 10,000. So 2 lakhs minus 10,000, what amount would the company receive? 1,90,000. Okay, after the discount means company will receive 100 minus 5, 95. So 2000 into 95, company would receive 1,90,000. Being 2000 debentures issued at discount, redeemable at par. Now the last situation to be covered, look at it, be attentive. Company issued. Now again when they say rupees 1 lakh means 1 lakh divided by 100,000 debentures are issued. Okay, 13% debentures at a discount of 5%, but redeemable at 10% premium. Now redeemable at premium will have effect on issue of debenture. You have to combine the entry of loss on issue to premium on redemption. So we will pass the entry of issue at discount, leaving one line in between. First you give the situations heading, issued at discount, redeemable at premium. First entry would be, for issue of discount will pass the entry leaving one line in between because they are redeemable at premium. So bank account debit, now issued at discount, so discount on debentures account debit, now leave one line in between and then you credit to, now we have which debentures, 13%, so to 13% debentures account. Now as we discussed, first we'll record the amount of debentures with face value, so 1000 into 100 face value, that would be 1 lakh. Now how much is discount in this portion? 5 rupees. 5% of 100 would again be 5 rupees. So 1000 debentures, what would be the discount? 1000 into 5 rupees, that is 5000. And 1 lakh minus 5000, what amount would the company receive? 95,000, or you can say 100 minus 5, 1000 into 95, company would receive 95,000. Now since they are redeemable at premium, you combine the effect, loss on issue of debentures account debit, and then at the end you credit to premium on redemption account. Now what is the premium on redemption over here? 10% premium means 10 rupees of face value 100. Okay, 100's 10%, 10 rupees. So this 1000 debentures into 10 rupees of premium, the loss on issue and premium on redemption would be with 10,000. So this way, if you pass two single entries leaving one line in between, you'll never make a mistake. Being 1000 debentures issued at discount, redeemable at premium. Okay. Total is not to be done because these all are different situations. Now this loss on issue would be written off. 10,000 is the amount of loss on issue to be written off, and security premium 50,000 is sufficient to write off that. So for that the entry will be securities premium account debit 10,000 to loss on issue of debentures account 10,000, being loss on issue of debentures written off. Okay, so these entries are to be passed, and as I said, total is not to be done because these are all different situations. All situations would not be there for any existing company. Okay, so question 1 is done, completely understood by everyone. This topic must be completely clear. Now university questions of similar kind you can practice on your own. Okay, that'll be all for this lecture. Bye everyone, take care, see you in the next lecture. Next lecture will take up with the next concept of issue of debentures for consideration other than cash. Bye everyone, take care.